Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Okay, so we're diving into the latest update here, and it really feels like a fundamental shift in strategy is hitting its stride. We're looking at a quarter that was just defined by, well, relentless product speed, right, and dramatic diversification. We're talking totally new asset classes. Plus, they hit record financial results. This isn't just them recovering. It feels more like a blueprint for scaling up into a really comprehensive financial ecosystem, one that's designed to capture that next generation of wealth.
That's a great way to put it. This Q3 2025 performance, it really does signal that their long-term strategy is maturing. It moves the company way beyond, its origins, just as a brokerage focused mainly on retail stock trading. So our mission here today is really to synthesize the most critical details, understand the strategic thinking behind these, frankly, massive numbers. When you dig into the underlying moves, the story is all about driving faster, profitable growth across these three distinct pillars. They're interconnected, though. Fueling the high-volume active trader, maximizing wallet share for the next generation, and fundamentally building out a truly global and institutional financial ecosystem.
Yeah, that framework, active trader, wallet share, global scale.
Yep.
I think that's the perfect way to look at it. And for you listening, we're aiming to go way beyond just the headlines. We're going to break down exactly how all these new products fit together. Things that seem kind of separate, right? Like that prediction market business doing, what, a $300 million run right now?
Yeah, unbelievable.
And the faster baking rollout. How does all that connect into this bigger, hyper-competitive financial structure they're building? All right, let's kick off with the financials. They kind of set the stage for everything else we'll talk about. Revenue basically doubled year over year. Doubled. Hit an all-time high, nearly $1.3 billion. I mean, in this environment where steady growth is tough for a lot of players, that kind of speed is, it's pretty shocking. But what really highlights the quality of this growth, I think, is their commitment to discipline.
Oh, the discipline is absolutely key. You mentioned the stunning revenue, totally agree. But look deeper. Look at the profit metrics. Earnings per share, EPS, it more than tripled from last year.
Right.
And year to date, up 150%. That shows real operational leverage. They've made this very clear commitment, right, to maintaining 75% incremental adjusted EBITDA margin.
Okay, let's break that down slightly. EBITDA earnings before interest, taxes, depreciation, amortization.
Okay.
And adjusted means they pull out some non-cash stuff for one-offs.
Exactly. And hitting a 75% incremental margin, that means for every new dollar of revenue they bring in, 75 cents of that dollar drops straight to the bottom line. That's extremely high. It signals a highly scalable, really profitable business setup.
And that scalability is clearly being fueled by money coming in. Capital inflows are also breaking records. This quarter alone, over $20 billion in net deposits, just Q3. And maybe even more telling, they've already blown past the full year 2024 net deposit record. That was $50 billion. And we still have a whole quarter left in 2025. That amount of asset inflow, it's not just background noise, is it? It feels like a critical vote of confidence from users.
Oh, absolutely. That flow of assets, it's the ultimate proof point for their primary financial account strategy. When customers get comfortable transferring bigger and bigger sums, cash, securities, basically moving their life savings over it, it confirms the platform is shifting. It's moving away from being just a site account for speculative trades towards being that primary trusted financial home.
And that confidence must be fueled by the diversification we mentioned. That seems like the most strategically profound piece of this update.
Yeah, I think so too.
I really want to unpack that diversification because it just fundamentally changes their risk profile, doesn't it? People used to criticize them for relying too much on, say, volatile retail stock trading or maybe crypto booms. Now they're proudly highlighting they have 11 distinct businesses. 11. And each one has passed $100 million in annualized revenue.
It's a really fascinating strategic pivot. It's all about horizontal stability. We can kind of guess what those 11 are, right? You've got traditional equities trading, options trading, margin lending, crypto trading. Then there's the cash sweep, the interest revenue, staking, the gold subscription service, Robinhood strategies, their digital advice platform.
Futures trading, too.
Futures, right? The newly acquired Bitstamp institutional platform, and of course, those explosive prediction markets. Managing 11 different businesses, all scaling past that $100 million mark at the same time. That takes immense internal agility, serious product management muscle. It means they're just not dependent on one single market cycle anymore. If stock volumes slow down, maybe crypto or prediction markets can pick up the slack,
And the momentum clearly hasn't stopped.
Yeah.
We're already seeing Q4 starting with huge energy. October apparently set new records across almost every major volume category. Equities, options, prediction markets, margin, crypto volumes, the works.
Yeah, that October data is critical. It confirms Q3 wasn't just a blip, right? Not just driven by some specific temporary market conditions. It suggests that the new products and features, the ones we're about to dig into, are genuinely drawing in new activity, higher frequency trading. And that's what sustains these high volumes, even as the calendar flips. The financial engine, as they put it, is running hotter than ever.
Okay, let's shift gears then to that first strategic pillar, the active trader. Their goal here is explicit, it's aggressive. They want to create an environment where active traders, these high-volume, really sophisticated users, sometimes called prosumers, feel like they're at a disadvantage if they use any other platform. The record trading volumes we just talked about suggest they're actually executing pretty well on that goal.
Absolutely. The Q3 volume numbers, record, equity, and options, and then seeing even stronger single-day and monthly records pop up in October, it shows they are successfully penetrating that prosumer segment. That's a group they traditionally kind of struggled with, right? Often seen as maybe too basic.
Yeah, definitely.
So this is being achieved through adding product sophistication, and that was really on full display at their recent HUD Summit.
Right. I want to focus on two big announcements from that summit, aimed squarely at that sophisticated user. First, the shorting capabilities.
Yeah, the rollout of shorting across multiple brokerage accounts. Okay, right now it's limited to internal employee testing, not out in the wild yet, but psychologically and functionally, that's a massive hurdle to cross. Short selling is just fundamental for sophisticated trading, for hedging strategies. If you don't offer it, you're automatically ruling out huge chunks of the experienced trading community. Introducing this shows they are serious about competing head-on with the established full-service brokers.
And then there's the tech angle. The introduction of these AI-driven custom indicators powered by something called Robinhood Cortex. That really jumped out at me.
Yeah, this moves way beyond just, simple AI stuff like customer service chatbots. Robinhood Cortex suggests they're using their internal AI power to chew through massive amounts of market data and then provide predictive or analytical indicators that are directly customized for a user's portfolio or maybe their trading style. This is about giving an analytical edge, embedding machine learning right into the trade decision process. That's a serious commitment to innovation. Not many traditional brokers can match that kind of tech integration.
But the really strategic differentiator here, maybe the product that ties the active trader into the whole bigger ecosystem, that has to be the new Robinhood Social, doesn't it? This isn't just like a standard forum or discussion board, is it?
Oh, far from it. No, this is a very deliberate ecosystem closing kind of move. Think about it. Historically, a trader gets an idea, right? Maybe they see chatter on some third-party site like X or Reddit or read a financial blog somewhere. Then they have to navigate over to their brokerage platform to actually make the trade.
Right. Separate steps.
Exactly. The idea behind Robinhood Social is to become the main source for idea generation inside their own platform. By integrating a rich social experience directly, they capture that whole life cycle of the trade. It reduces the need for users to ever leave the app.
Okay, that sounds like a powerful flywheel effect. But it immediately brings up questions about regulatory risk, doesn't it? We all know financial social media can be a minefield. Misinformation, pump and dump schemes. How does their version handle those built-in risks?
That's a huge challenge, no doubt. They have to navigate that very carefully. Their key competitive edge here, what makes it different, is the ability to offer live, verified trades across their whole multi-asset platform, stocks, options, crypto, futures, prediction markets.
Verified, meaning you can actually see what real accounts are trading.
That's the idea, yeah. Theoretically, that combats the anonymous shilling, the potential manipulation. But still, integrating social content directly with execution tools, that requires super careful compliance monitoring. They have to make sure they're not accidentally facilitating market manipulation or giving out unlicensed investment advice. And the monetization strategy seems to reflect that caution. It's not primarily about direct ad revenue, from what they've said.
Right. The value is in the flywheel itself. You attract customers with this rich social experience, which then leads to them capturing a bigger slice of the trading activity across all those profitable asset classes.
Precisely. It's an engagement tool first, a revenue driver second, because that engagement drives volume. And crucially, no other platform currently offers this seamless combo multi-asset trading with real-time verified social input all integrated right there on the trading screen. That unique structural advantage is really key for holding on to that high-velocity trader.
Okay, moving into crypto for a sec. We see another move targeting that prosumer trader with this smart exchange routing offering. They mentioned blended take rates in the high 0 cents zone. For the listener, what exactly is smart routing, and why is that pricing so aggressive?
Right. So smart exchange routing in crypto basically means the platform uses tech to automatically scan a bunch of different exchanges, dark pools too, to get the best possible execution price for the user. They usually split the difference between the price you see and the price they actually get it executed at. This is a sophisticated pricing strategy shift for them. It's moving away from just a single low flat rate for everybody.
It's becoming more personalized.
Exactly. They're introducing personalized pricing. For those prosumer traders, the ones bringing in massive, consistent volume, they can now offer pricing that's extremely competitive, even competitive against major institutional crypto exchanges. They admitted they were underpenetrated in this high-volume group before. This move is designed to make their platform the default choice for serious crypto players.
Makes sense. And they're capturing passive crypto assets too, right?
Hmm.
Customers seem to be engaging with crypto staking. About $1 billion in assets staked at the end of Q3.
Yeah, staking is a key sticky feature. It lets customers earn yield, basically interest, on their crypto holdings passively. By offering this, they incentivize users to hold large amounts of crypto on their platform for the long term. That increases customer assets, drives that wallet share goal, and creates a stable, recurring revenue stream from the staking fees. It's a classic move. Provide utility to lock in those assets.
Okay, so if the sophistication push is working for the active trader, this prediction markets business is, well, it's a rocket ship.
Yeah.
We already mentioned it was the fastest business in their history to hit $100 million in annualized revenue.
Less than a year, right?
The speed of adoption here is historically significant. It really shows they tapped into this massive kind of hidden demand. The growth rate is almost unprecedented. Volume has been like doubling every quarter since they launched it. Q3 saw $2.3 billion in contracts traded, and then October alone blew past that, hitting $2.5 billion. Wow. And based on that huge October activity, the run rate is already tracking towards $300 million in annualized revenue. I think for you listening, we need to clarify what makes this unique. It's not just a gambling service, right? What kinds of contracts are we actually talking about? How are they structured differently?
Right. Good point. Prediction markets are essentially contracts that let users speculate on the outcome of future events. Politics, economics, tech, culture, whatever. They're regulated as derivatives contracts in the specific markets where they operate. Their core strategic value is that they kind of formalize collective human belief into something quantifiable, something tradable. They effectively price risk on future events. Initially, yeah, the platform focused heavily on those high-profile political markets, but they've rapidly expanded the contract diversity, now offering over 1,000 live contracts.
Can you give us a couple of examples of that diversity just to illustrate?
Sure. So beyond the obvious stuff like, will candidate X win the election, or what's the Fed going to do next? They're moving into more niche, high-interest markets. We're seeing contracts focused on cultural stuff like, will streaming service Y renew Show Z?
Interesting.
Or, on the tech side, will the next big phone release have a folding screen? Stuff like that. This expansion into economics, culture, technology, it ensures engagement keeps going beyond just the seasonal political cycles. And that confirms their strategic vision. They see this as a major, evolving asset class for pricing risk across pretty much all aspects of public interest.
That expansion seems crucial for longevity, doesn't it? If it was just elections, it'd be a very cyclical business. By expanding into year-round topics, they ensure that high-volume activity can be sustained.
And this ties right back into that ecosystem advantage we keep talking about. Being the only platform that offers prediction markets fully integrated alongside crypto, options, stocks, futures, all in one simple platform. That gives them a huge structural edge. A user can flip instantly from trading an S&P 500 ETF to betting on the next big economic indicator. That seamless integration just eliminates friction.
Got it. Now, regarding the volume numbers, they clarified something important. The reported volumes are specific to their platform, but they represent a big chunk of the volume sent to associated venues. What does that mean exactly?
Yeah, that distinction's important. It basically highlights their massive distribution power. While the actual contracts might technically be executed by a partner venue, the user experience, the customer flow, and crucially, the resulting revenue that's all captured within their ecosystem. Looking ahead, the international potential here is just vast, especially since prediction markets often have a strong crypto component. They can leverage that crypto infrastructure in different countries, adapting their approach based on local regulations. It's clearly seen internally as a top-tier growth area for the next few years.
All right, let's pivot now to the second pillar, winning wallet share. This strategy is all about converting existing users, maybe those high-frequency traders, into long-term wealth builders. It's about capturing a piece of that massive, $120 trillion generational wealth transfer that's happening right now. That transition requires totally different products, right? Products designed for stability, for trust.
Exactly, and the stats really back up their success so far. Total customer assets have grown significantly and now over $333 billion. That growth reflects their success in positioning the platform to handle long-term money, retirement-focused money. It's moving beyond just being seen as a simple trading app for millennials.
And those long-term money products are performing incredibly well. Retirement accounts like IRAs, they've more than doubled in just the past year, now over $25 billion. And that digital advice service, Robinhood Strategies, launched only back in March. It's already racked up over $1 billion in assets.
Yeah, the speed of growth in Robinhood Strategies is really remarkable. It makes it one of the fastest growing digital advisors out there today. This product is key because it captures assets from customers who actually want to delegate some of their investment decisions to algorithms. That signals a really deep level of trust in the platform's long-term financial viability, its fiduciary responsibility, not just its ability to execute trades quickly.
But the true super app strategy, that really seems to hinge on the banking services, doesn't it? The Robinhood Gold Card, for instance, has been a huge success. Over 500,000 cardholders now, processing $8 billion in annual spend. That's like 5x growth in cardholders just since the start of the year.
Yeah, the credit card success really validates customer behavior. It shows their willingness to integrate these complex, high-engagement financial products into the ecosystem. And that positive validation clearly gave them the confidence to speed up the rollout of Robinhood Banking. They're in early customer rollout now, and they expect it to move relatively quickly. Why? Because the underlying economics, managing cash, checking accounts, it's actually simpler than the specialized underwriting you need for a credit card.
And the core appeal of the banking product seems pretty competitive. Customers get interest on both savings and checking balances. That simplifies their whole financial picture. But here's my critical question. The ultimate goal, they say, is to make the platform the primary place where customers direct deposit their paychecks. Isn't this where the big guys, the JP Morgan Chases, the Schwabs, have almost insurmountable scale and generations of trust built up? How does this platform really break through to become that primary banking relationship?
That is the multi-trillion-dollar question, isn't it? The incumbents definitely have history, scale, physical branches. But the strategy here isn't really to just copy a legacy bank. It's to leverage their strengths. Superior tech, that zero-fee structure, the speed of integration. By offering checking, savings with yield, plus instant access to a full suite of investment products all in one highly integrated app, they aim to simplify financial life for that next generation. The generation that prioritizes digital experience way over branch convenience.
And getting the paycheck is the key.
Capturing the paycheck is the golden standard, because once that paycheck flows through their system, they capture all the subsequent cash flows. That enables frictionless cross-selling of investment products, cards, future services. It's the linchpin.
We're also seeing a clear shift towards what they're calling the family financial hub strategy. They're trying to differentiate by designing the platform with the whole household's financial needs in mind.
Yeah, this focus is essential if you want to capture that generational wealth transfer, which often involves moving assets between family members, managing complex estates. They're anticipating future opportunities, like making it easier to create accounts for partners, kids, maybe even household staff. And crucially, they're actively considering future account types needed for wealthier, diversifying customers, things like trusts, custodial accounts. It's subtle, but it's a powerful signal. They're building the infrastructure to keep customers even as they accumulate significant wealth.
Right. And for those customers whose needs eventually get too complicated for just digital advice, they mentioned the upcoming integration of Trade PMR. What exactly does Trade PMR do in this super app picture?
Trade PMR is a really smart strategic acquisition. It's designed to be a crucial complement to their digital services. Basically, Trade PMR is a tech and custody provider that serves registered investment advisors, RIAs, human financial planners. Its integration means that as customers get wealthier and their financial situations get really complex, needing custom estate planning, tax optimization, intergenerational wealth transfer stuff, the platform can still serve them. By providing a seamless bridge to traditional human advisory services, it ensures they retain those customers by offering a high-touch option. It prevents the platform from losing its most affluent clients to traditional wealth managers once their needs grow beyond the basic digital offering.
Okay, moving to that third strategic pillar, building the global and institutional ecosystem. The 10-year goals they've stated here are, well, they're truly audacious. Over half their revenue and customer base outside the U.S., and a majority of revenue shifting from retail to non-retail or institutional customers. These goals signal a desire to become like a foundational layer of global finance.
Yeah, these are not small incremental targets. This requires a total transformation of the business model over the next decade. That level of growth simply has to be found internationally and by serving sophisticated institutional players. Those players provide steady, high-volume flow, and this is precisely why that Bitstamp acquisition is absolutely vital to the long-term vision.
Let's look at Bitstamp's performance then, since the acquisition. Volumes are up over 60% quarter over quarter. That suggests the integration is moving fast.
It really is a success story in terms of acceleration. Bitstamp is positioned as the company's first truly scaled institutional business. It gives them the regulatory permissions, the infrastructure they need to service sophisticated European and global crypto firms. But its strategic importance goes way beyond just trading volume. It's explicitly tied to their future tokenization plans, specifically Phase 2, which we'll get to. Plus, the institutional arm provides this invaluable feedback loop. Institutional clients are highly discerning. Their critical input drives rigorous product improvement across the whole ecosystem, which ultimately benefits retail customers globally too.
Right, speaking of tokenization, let's talk about the rollout of stock tokens in the EU. That's Phase 1. They now offer over 400 public companies as tokens, making it one of the biggest selections available.
Yeah, in Phase 1, these tokens are essentially digital wrappers around traditional U.S. or global public company stocks. The current revenue model is pretty straightforward. They charge a simple foreign exchange fee, 10 basis points, when a customer buys a stock token denominated in, say, euros instead of dollars. What's economically significant here is that this 10 basis point fee is actually slightly higher than what they might typically get from payment for order flow in the U.S. market. So it confirms that offering this new asset class is economically viable, even in this initial, highly controlled phase.
Okay, and the three-phase rollout vision is key to understanding the truly disruptive potential here. Phase 1 is basic access. What about Phase 2 and 3? And why is Phase 3 considered so ambitious?
Right. Phase 2, which leverages Bitstamp's infrastructure, will introduce secondary trading of these tokens. That's crucial because it ensures deep liquidity and market reach, moving them beyond just being the primary issuer. Phase 3, that's where the tectonic plates really shift. It involves migrating these tokenized assets onto decentralized finance DeFi platforms.
Okay, DeFi, remind us.
Yeah, DeFi refers to financial applications built on blockchain technology, operating without traditional middlemen like banks or brokers. This transition unlocks really powerful possibilities, things like self-custody, meaning the user holds the asset directly in their own digital wallet, and more importantly, financial utility, like using that tokenized stock as collateral to borrow money instantly, 24/7. It fundamentally changes the nature of the asset from just an investment you hold to something functional you can use.
Phase 3 sounds incredibly ambitious, moving assets onto DeFi platforms. But given all the regulatory uncertainty around stablecoins, decentralized exchanges globally, isn't that timeline incredibly risky? And also, if these tokens are built differently on various blockchains, doesn't that just fragment liquidity all over again?
That risk is definitely present, absolutely. But it's probably a necessary risk if they're genuinely committed to pioneering the future of finance. Regarding fragmentation, yeah, they address that directly. They acknowledge that right now, the tokens operate in a kind of walled garden. That provides a controlled, regulated environment to start. However, they expect to achieve greater interoperability over time. Through things like community-built bridges and wrappers aiming for a multi-chain existence, they emphasize that managing liquidity across multiple venues, which is basically the definition of fragmentation, is standard practice in global financial markets anyway. Their core belief is that crypto infrastructure is actually uniquely positioned to simplify, not complicate, this integration complexity eventually, making cross-border trading easier than it's ever been.
Zooming out a bit, the leadership seemed to hold this core belief that tokenization will eventually kind of eat the broader financial system. What specific future tokenized assets are they particularly interested in?
They believe tokenization unlocks access and efficiency for assets that are traditionally super illiquid or reserved only for the ultra-wealthy. So they're intensely focused on future tokenized assets like real estate, private credit, unique assets, even high-value collectibles like art.
Wow. Okay.
The massive benefit is allowing regular retail access to these historically exclusive asset classes. It reduces the downsides, like the lack of liquidity, and it enables real-time 2047 trading of fractional quantities. You could own, 0.01% of a skyscraper or a famous painting. It truly democratizes previously inaccessible assets, which aligns perfectly with the company's core mission from day one.
And that leads us perfectly into maybe the most revolutionary part of their strategy, democratizing private markets through this new thing called Robinhood Ventures.
Yeah.
They're directly tackling a critical inequality in the financial system, aren't they?
Yeah.
Companies are staying private way longer, reaching these massive valuations, hundreds of billions sometimes, and that locks out non-accredited retail investors from the most innovative sectors, like AI, space tech, you name it.
It creates this huge disparity. Yeah.
Mm-hmm.
The bulk of the wealth creation is now happening before a company even hits the public market, which means the average retail investor is only allowed to buy in after the most explosive growth phase is already over.
Yeah.
They've already seen some success challenging the status quo with their IPO access program, right? That's basically forced almost every notable company going public now to engage with them on retail strategy, retail allocation.
So Robinhood Ventures takes that fight one step further. It's them providing exposure to private companies specifically for the non-accredited retail investor. That's what, 85% of Americans who are currently shut out from this kind of wealth generation?
Yeah, the customer demand for this access, especially to those beloved, best-in-class tech companies, it's just enormous. When designing this product, they really had to solve three core problems for the average user. One, how do you provide liquidity? Because private assets are inherently illiquid, hard to sell. Two, how do you get around that pesky accreditation requirement? And three, how do you offer concentrated portfolios that actually focus on those really desirable company names people want?
We know they've made initial investments already, and they're working towards a public offering for something called Robinhood Ventures 1. But how are they possibly managing the immense regulatory complexity, the structural challenges here, especially since they're in this quiet period with the SEC right now?
Right. The quiet period is standard SEC procedure while they prep the registration statement for a public offering. The mechanism they're pursuing has to be highly innovative. Details are obviously scarce because of the quiet period, but the leading theories suggest they might be structuring Robinhood Ventures 1 as a form of continuously offered non-traded vehicle, maybe something similar to a tender offer fund or perhaps a non-traded REIT structure. These structures can allow for things like daily liquidity windows solving problem one, and they're often registered under the Investment Company Act of 1940, which could allow non-accredited access solving problem two. It requires navigating some serious regulatory hoops, but it would be an absolute game changer if they pull it off.
And they definitely view this as just the beginning, right? They have large ambitions in the private market space.
Absolutely. This isn't just about launching one fund. It's positioned as a primary engine for future growth and fulfilling their core mission. It requires not just a new product, but real innovation in how they partner with private companies, convincing those companies to allocate a slice of their valuable private equity to a vehicle designed specifically for retail accessibility. If they succeed, this venture could fundamentally democratize the entire venture capital ecosystem, fulfilling that long-standing promise to break down financial barriers.
Okay, this incredible amount of product output we've just discussed, prediction markets, banking, ventures, social, that doesn't just happen by accident. It requires serious underlying operational strength, what they keep calling product velocity. Let's try and analyze the factors contributing to this rapid execution we're seeing.
Yeah, they cited four key drivers. First, the foundational work they did post-COVID. It's easy to forget, but just a few years back, this company really struggled with basic scaling during high-volume periods, right?
Yeah, definitely remember that.
The structural rebuild of their culture and infrastructure since then is kind of the unsung hero of this whole story. It allowed them to get fit again, operationally. Second, their early and depth adoption of AI. They really consider themselves leaders in deploying AI at scale within financial services. They say it's driving significant impact in customer service, but also, crucially, in engineering efficiency, which means faster code deployment, getting products out quicker.
What about structural changes within the organization itself, things that enable speed?
Right. That's the third point, implementing a general manager or GM model. This pushes decision-making authority down to the business unit level. So each GM owns their specific product line, like prediction markets or crypto. They own its P&L, its KPIs, its milestones. This drastically speeds up execution because those leaders own their goals. They don't need constant sign-off from the top for everything.
Makes sense.
And fourth, it comes back to that financial discipline we mentioned earlier. Having clear alignment across all the teams on ROI, on those 75% incremental EBITDA guardrails. Once a decision is made to build something, execution is fast because the financial groundwork is already agreed upon and approved, less back and forth.
Now, even strong systems hit turbulence. They did acknowledge that recent AWS-related outage, which kind of degraded app performance across the whole internet for a bit.
Yeah, that event, which was third-party, driven by Amazon Web Services, actually served as an unplanned stress test. They highlighted that the investments they've made in system resilience over the past few years meant their core infrastructure wasn't fully down, which is a major step forward from where they were previously.
Okay.
But they admitted services were slowed down, and they're committed to using every single outage, regardless of whose fault it is, as an opportunity to further strengthen their internal resilience. The stated goal is crystal clear. Be robust enough to serve as a customer's primary and secondary financial account. That means they have to achieve near-perfect uptime and reliability. No excuses.
Got it. Finally, let's cover the leadership transition happening in finance. Jason Warnick announced his retirement, stepping down from the operating role in Q1 2026, but staying on as advisor until September 1st.
Yeah, the transition appears really seamless, very well planned. Shiv Verma, who's the current SVP of Finance and Strategy and Treasurer, and importantly, has 7 years with the company he's taking over as CFO. Shiv's stated priorities are a direct reflection of the current financial strategy. Commitment to sustained, profitable growth, maintaining that lean, disciplined culture, and a strict focus on capital allocation and ROI. Basically, he's tasked with keeping the profitability momentum going while simultaneously funding all these massive growth initiatives we've discussed.
And the financial North Star, that key metric for shareholders, that remains absolutely steady through this transition.
Totally unchanged. The North Star is centered on maximizing shareholder value over the long term, which means dedication to growing earnings per share and free cash flow per share. That ensures continuity, clarity for investors, despite the change in leadership at the CFO level.
Okay, looking at the cost outlook now, we need to factor in those strong performance-related bonuses tied to this record year they're having.
Full year 2025 adjusted operating expenses plus share-based comp. It's tracking around $2.28 billion now. That's a slight tick up from previous guidance, but is driven primarily by two arguably positive factors. One, strong performance-related employee bonuses basically paying for success. And two, an unplanned payroll tax expense related to the CEO's big 2019 market-based award finally vesting. That's now fully settled, off the books going forward.
And the approach to expenses in 2026 seems to reflect that disciplined growth strategy, growth fueled by efficiency gains.
Precisely. The plan is to grow, yes, but while still ensuring margin expansion. The strategy dictates that the existing, more mature businesses, they're tasked with finding efficiencies, growing their cost base only in the low single digits, maybe even lower. Those operational savings are then strategically reinvested into the new high ROI growth areas. They specifically cited marketing, prediction markets, and that critical development of the ventures platform. It's a very calculated reallocation of resources to maximize future growth speed.
So wrapping up, this quarter really demonstrates a company that's fully executing on its long-term vision. To recap, we saw dramatic product diversification, the explosion of prediction markets, the acceleration of banking services aimed at capturing the paycheck. We saw major institutional moves with Bitstamp's integration and that global push through tokenization, really focusing on becoming an infrastructure layer. And critically, we saw these strategic maneuvers to capture the generational wealth transfer opportunity serving the whole household, actively trying to democratize access to the most exclusive asset class out there. Private markets.
Yeah, the synthesis is clear. The platform is successfully building both breadth and depth at the same time. They're creating the sticky, multifaceted ecosystem that's becoming increasingly hard for competitors to copy, particularly given how integrated things like social, prediction markets, and those advanced traditional brokerage tools are becoming. The aggressive push into private markets access, the deep dive into global tokenization, it positions them not just as a brokerage anymore, but potentially as a future financial utility infrastructure, really bridging that gap between traditional finance, TradFi, and decentralized finance, DeFi.
I still think the biggest potential, and maybe the most challenging part, is tied up in those really early stages of private markets access and that whole global tokenization roadmap. Successfully executing those two pillars feels like it will fundamentally define the future scale of the company.
Indeed. And it raises a huge, really forward-looking question for everyone listening, especially when you consider this convergence of TradFi and DeFi, spearheaded by platforms like this that are actively trying to bridge the two worlds. If this trend continues and they actually succeed in making previously exclusive assets truly accessible, how might this convergence fundamentally change what the average person includes in their diversified investment portfolio, say, 5 years from now? Imagine when assets like tokenized real estate or private equity stakes or collectibles are suddenly available as fractional 247 liquid tokens. That shift could be genuinely revolutionary for personal wealth management.
That's a fascinating thought to end on. The democratization of previously elite asset classes, definitely something we will be keeping a close eye on. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Till next time, stay curious and stay informed.